Hi, I'm David Berson, Senior Vice President and Chief Economist for PMI. Welcome to the December issue of PMI's Housing and Mortgage Market Review. It's now official. The Business Cycle Dating Committee at the National Bureau of Economic Research recently noted that the end of the previous expansion and the beginning of the current recession occurred in December 2007. As a result, this downturn has already lasted 12 months and it shows no signs of ending. In fact, virtually all of the recent economic data suggests the downturn continues to intensify. For example, non-farm payroll employment fell by 533,000 in November, the biggest decline since the end of 1974. As a result of the ongoing dismal economic data, we have lowered our forecast for real GDP growth in the current quarter, with an estimated annual decline of 4.7%. This would be the biggest one-quarter drop since 1982. As we noted in last month's report, the average recession in the post-war period has been 10 months, so this recession is already longer than average. We continue to expect a modest recovery beginning in the second half of 2009. While the beginning and end of recessions don't necessarily correspond with real GDP growth turning points, they're close enough. If we assume that the end of this recession is June 2009, then it will have lasted for 18 months, making this the longest recession since the 1930s. Longest doesn't automatically mean worst, however, and we continue to expect that in terms of job loss, this will look more like an average downturn than a severe one. Of course, some sectors in the economy have been hit more severely than others, with housing suffering through a massive downturn as a key example. Thus far, job losses have been far less than in a normal recession. In part, this smaller decline in jobs has occurred because the monthly losses through October were much less than usual. Of course, if the pace of November's drop continues, then the percentage decline in job loss would increase rapidly. But to equal the peak 12-month declines that we saw in the severe recessions of 1973-75 and 1981-82, which were approximately 2.7%, would require massive additional job declines. If we assume that the recession ends in June and job gains begin again in July, then we would need to see an additional 7 consecutive months of job losses equal to November's plunge in order to match the 73-75 and 81-82 percentage declines. While this is possible, it seems unlikely. Our current forecast is for a longer than average recession, but an average downturn with respect to severity. The massive amount of monetary and fiscal policy stimulus that we've seen in recent months, with more on the way, as well as sharp drops in energy prices, suggests that the economy should begin to grow again by mid-year, given the lags involved. As we've seen in recent recessions, the unemployment rate is expected to peak after the downturn is over, probably a bit over 8% in early 2010. For all of 2008, we project a drop in real GDP of 0.4% on a fourth quarter to fourth quarter basis. The downturn should moderate in the first half of 2009, with modest expansion over the second half of the year, leading to real GDP growth of 0.3%, clearly not much of a gain. For 2010, growth should accelerate and move above trend. Households are likely to continue to be constrained with respect to borrowing, so growth in 2010 will probably be less than normal in the first year of a recession, at only around 3.1%. Still, above trend growth should allow unemployment rates to decline at least slowly in 2010, ending the year around 7 to 7.5%. Even with this relatively high unemployment rate, the Fed is likely to begin removing liquidity from the economy in 2010 in order to ensure that inflation or asset bubbles don't arise, resulting in higher interest rates as the year progresses. In every recession from 1969-70, the earliest period for which sales data are available, housing rebounded before the end of the downturn. And since the end of recessions typically occur before unemployment rates peak, housing recoveries begin long before unemployment rates begin to turn down. We expect that pattern to repeat in this cycle, with home sales recovering modestly in 2009. Even new home sales should edge upward over the second half of the year. It has always been a combination of rising home affordability and increasing pent-up demand for housing that has boosted home sales in past downturns, and the same should occur this time. Affordability has already risen to the highest level since 1973, and this is before the most recent declines in mortgage rates. Once these are factored in, affordability should rise to an all-time high. Moreover, sales have been below long-term demographic trends for the past couple of years, suggesting that pent-up demand is increasing. The buildup in the housing market in 2009 is unlikely to be robust, however, until the job market starts to recover in 2010. Stronger job growth in that year should allow a more robust rise in home sales in 2010. Even with the modest sales gain that we project for next year, national home prices are forecast to fall further because of the large number of homes still for sale. But the worst national home price drops are probably behind us, and by 2010, national home prices should move upward again. The latest data, released as this report was being finished, show that yields on conforming conventional prime 30-year fixed-rate mortgages dropped to less than 5.5%, the lowest level since March 2004. Given the worsening recession, we expect the Fed to continue to aggressively add liquidity to the economy. In the near term, we will see this through another cut in the federal funds and discount rates at the December Federal Open Market Committee meeting, probably bringing the federal funds rate down to 0.5%. This is as close to zero as it can probably go, but it doesn't mean that the Fed will be done easing. We expect it to purchase other high-grade securities, both government and private, in order to increase market liquidity further in 2009. Eventually, the Fed will succeed in boosting economic activity. At some time after that, the Fed will begin to withdraw the massive amounts of liquidity it is currently adding, thus boosting interest rates. But that's a story for 2010. For 2008, we expect that total mortgage originations will fall to $1.84 trillion from around $2.5 trillion in 2007, with the refinance share at about 48%. The ARM share, the share that goes to adjustable rate mortgages, should average only about 7.5% in 2008. For 2009, originations are projected to slip a bit more to around $1.75 trillion. But given the sharp drop in mortgage rates, the refinance share of the market is expected to move over 55% for next year. Despite the decrease in mortgage rates, many borrowers are equity constrained and so are not able to refinance. Otherwise, the refi share would have risen still more. Origination should finally begin to increase again in 2010 as home sales rebound more strongly and national home prices finally begin to rise. Thank you again for joining us for the December issue of PMI's Housing and Mortgage Market Review.